This is some basic CPA stuff that you really need to know about hedge accounting. And again, I didn't go, I think I gave you enough to do some journal entries for fair value hedges. I certainly didn't give you enough to be able to do journal entries for cash flow hedges. It's kind of intentional. I've been trying to teach it for years. And what I found is that my presentation and the amount of time that I have, I can't give you something comprehensive enough. So you should be able to do it on homework and work it out through homework, but I would not test you on journal entries for a cash flow hedge, and I'll just tell you that in advance. Learning Objective 11-4, how to measure hedge effectiveness, make interperiod tax allocations for foreign currency transactions, and hedge net investments in a foreign entity. So let's go through these additional considerations here. And these are just multiple choice questions on the CPA exam. Regarding hedge effectiveness is the idea that a hedge is meant to offset changes in value of an underlying. And you need to make sure that it's actually working, because you could have a hedge that doesn't move, that moves in the same direction as the underlying, or it doesn't move enough to really make a big difference. So there needs to be, the offset doesn't need to be exact, but it should be within 80 to 125% of the changes in the fair value of the cash flows or fair value of the risk being hedged. And from what I understand, the FASB doesn't exactly say 80 to 125%, but that's what's generally accepted. That's what everybody does. You need to do this at least every 3 months, and you need to do it every time you report financial statements. So two different approaches are called the intrinsic value approach and the time value approach, and more sophisticated reporters are going to do both. And what you would do basically is you would establish these guidelines when you document your hedge. So you would establish exactly how you're going to test it, what the criteria are, how often you're going to assess it, and then you need to follow through with that when you actually are having the hedge. Now, an issue comes up with tax allocation for foreign currency gains, because we've said that what we're often doing is we're moving gains and losses between periods, especially when it comes to cash flow hedges. So these create temporary differences, and therefore they result in deferred tax assets or liabilities. Enough said. Now, this is really cool. We're going to see more about this in Chapter 12. What could happen is if you have a subsidiary whose functional currency is not the same as the parent. In other words, you're the United States, your parent company in the United States, and you have a foreign subsidiary in Canada. And the Canadian subsidiary, their functional currency is the Canadian dollar, and most of their transactions are in Canadian dollars. So their whole balance sheet and their whole income statement are in Canadian dollars, and you, the parent, your balance sheet and income statement are in dollars, US dollars. So what could happen is that the value of their balance sheet is going to float. It's going to change as the value of the Canadian dollar changes in proportion to the value of the US dollar. So you're going to have a whole subsidiary that's going to change in value every year. The balance sheet will change in value. And what are you supposed to do about that? Because that really is a gain or a loss. And what we're going to see is that you can hedge it. And it's a very simple hedge. It would be debt on the books of the parent denominated in the subsidiary's currency. Because when the subsidiary goes up in value, this is assuming, of course, the subsidiary has a net asset position. You know, they have positive equity. So that equity, your investment in the sub, is constantly going to be changing with the value of the foreign currency. But if you have a liability denominated in the same currency, then the liability will also change in the opposite direction, and the gains and losses will offset each other. And if you do this properly, if you document it and everything else, then these differences in gains and losses should offset each other, and they can all go to other comprehensive income. And it's called a hedge of a net investment of a foreign operation. And it goes to OCI. And you can continuously place it into OCI.